Yes. Good morning. I am Steve Buller, Portfolio Manager of the US REIT Fund that we distribute in Japan. As depicted in this graph, in the good or normal periods, NOI or net operating income growth year over year in the REIT industry is usually between 2 and 4%. In the early 2000s recession and in the Lehman shock, the global financial crisis, it turned negative by a small amount. Now, due to the pandemic, it has dropped to negative 4% year over year. This is due to rent collection issues and the impact to many of the bad REIT sectors, such as retail, lodging, and urban apartments. We have one now. We would anticipate 2021 to revert back to positive year over year NOI or net operating income growth for a couple of reasons. 1, easier year over year comparables. 2, better clarity on rent collection for most sectors. And 3, the good REIT sectors, such as industrial and data centers and manufactured housing, should have distinctly positive growth in 2021. The recent presidential election should have very limited impact on US REITs, as there is nothing that really was bad in any of the Democratic proposals. At worst, there might be higher taxes, but that would impact all sectors and the economy and perhaps the stock market. That is all for this question. This chart talks about REIT valuations from an implied cap rate spread and also a dividend yield perspective. The chart on the left is the implied cap rate. That is the NOI yield of the entire REIT market minus the 10-year US Treasury yield over time. As you can see, the spread gapped out due to the pandemic as there was uncertainty of rent collection in some sectors and the future direction of NOI growth. As we talked about in the previous slide, we believe NOI growth will rebound in 2021. So one could argue that US REITs are cheap today. In previous periods, when this spread was this wide, especially to the average spread of 358 basis points, REITs have performed very well thereafter. On the right side, we have the REIT dividend yield spread minus the 10-year US Treasury. Once again, this spread is near historic highs, except for the global financial crisis, and way above the long-term historical average of 1.39%. This chart could also be interpreted as signaling that US REITs are inexpensive. That is all for this question. Yes, this slide shows the emphasis over time of the stock's characteristics of my fund's holdings. My goal as a portfolio manager is to predict or to adjust what the REIT market has given me in adjusting the fund's holdings over time. As depicted and discussed earlier, the fund moved from being growth versus value to more risk off versus risk on due to the pandemic. The biggest factor in determining this is the sector classification. The fund currently is overweight the risk-off sectors, such as industrial, data centers, single-family rentals, and manufactured housings, which we will show the positioning on the next slide. That is all for this question. This slide shows the fund positioning by sectors. The fund is overweight industrial due to demand from e-commerce, more inventory, and higher domestic onshoring of manufacturing. The fund is also overweight data centers, as I mentioned earlier, due to increased digitalization of both consumer and commercial processes, which require data storage and data interconnection. The fund is underweight malls, actually no ownership, because of the long-term structural damage to this business. There's too much retail in the US, higher e-commerce penetration, and currently a lot of bankruptcy by retail tenants. That is all for this question. Yes, this slide shows two overweight stocks the fund owns, Digital Realty and Duke Realty. The fund likes Digital Realty due to the strong demand for data centers from both consumer and corporate users for the aforementioned data storage and interconnection need. The fund likes Duke Realty. It is one of the largest overweight positions in the fund, and it is one of the largest owners and developers of very large logistics facilities in the United States. Its largest customer is Amazon, where we continue to see tremendous demand for logistics facilities. That is all for this question. In closing, I hope you come away from this presentation feeling positive about U.S. REITs and with Fidelity managing the fund. Fundamentals should improve in 2021, especially in the good and growth sectors, and we feel valuations right now are very compelling. Using our depth of resources, we feel are positioned properly in these good and growth sectors. Once again, I thank you for your time and your interest.